Welcome to Monday Night Live, the weekly training that guides professionals to financial prosperity. Join our community and let's start building your wealth.
Yeah. All right. Perfect. Well, let's just, without further ado, why don't we just jump into it? Let's give them the meat and potatoes. So how do top producers pay pennies in taxes? That's what we're going to be talking about here tonight. There's only one topic we're going to talk about: taxes. I'll do my best to keep everybody awake. How about the high level, the disclaimer? I'm not an accountant. I'm not a CPA. I'm not an attorney. I don't play one on TV. The information here is intended to really for education only. So always consult your accountant, your attorney, your CPA for legal and financial advice. First, let's talk about some context, right? And in terms of what we're talking about and what you guys live on a daily basis. You know, as a realtor, at the end of the day, you're up against a handful of things for the successful folks. Giant tax bills, number one. An income roller coaster, which, Gary, I know you talk about. On call, I'm talking about traditional agents, on call 24/7. You've got solo retirement planning. You know, we as realtors, we're given a 401k, a 403b, some sort of IRA from my employer. We're on our own at the end of the day. And a market and economy that us as individuals just don't control. My solution: passive income from real estate. Now I'm going to get into that because we're talking about taxes, remember? So I'm going to get into that. But first, let me talk about, before we go any further, really what I'm not. We're going to be talking about taxes tonight. I can promise you by the end of tonight, I'm not going to have you, Tony Robbins, excited enough to walk on hot coals. Okay. I'm not going to be talking about just keep buying. And I know we're going to be talking a bit about passive income, but I'm not going to, I can't make you go back in time. And I'm not going to be talking about making tens of thousands a month through some sort of online clickbait thing. We're talking about real estate here. And I'm not here to sell you a single thing. I'm here to educate you. So passive income, what can it actually do? Well, it can actually help reduce your tax bill. And I'm going to get into that. You're going, how do I make more income and pay less? Well, we're going to dive into that tonight. It can allow you to take more control of your time and your schedule. You spend more time doing the things you actually want to do, working with the people you actually want to work with, and say just no thanks to those who don't. And avoid showing houses when you're 88 years old, unless that's what you love to do. So who am I? And then, at the end of the day, why am I even talking to you? Well, I became a realtor in 2004 after my mom in her first year made twice what I made when I was working as a banker. That was enough for me to get in and go, if mom can do it, I can do it better. I became Rookie of the Year. 3 years in, I owned a RE/MAX. When I was 29 years old, I was the number one RE/MAX agent in the state of Iowa. That year, I was named to Wall Street Journal's top 100 team. My first year in real estate, I paid more in taxes than my entire salary the year before as a banker. So it's kind of one of those things, like good, but not good. At the end of the day, when I had my RE/MAX, I was burning the candle at both ends. I was hardly at home. I would take 10 to 12 days, calendar days off. Calendar days, I'm not talking business days, calendar days. When you're a realtor, every day is a work day, right? 10 to 12 calendar days off in an entire year. My success almost cost me everything. I was just about 31, maybe 32 years old. I came home one day. My wife had herself and 3 kids, 5, 3, and 2, packed up in the minivan, and she said she was leaving for good. I had done everything I thought I was supposed to do as a man, as a business owner, to invest in the success of myself for the benefit of my family. And at the end of the day, my family, it wasn't about selling one more property or cashing one more commission check. They just wanted, the only thing they wanted was time. So I pled with my wife to, give me a period of time to change. So thank God she agreed. 30 days later, I sold my RE/MAX. I left the real estate industry. It took about a year off of circling the wagons, trying to figure out what I was supposed to do with my life. Fortunately, I was in a strong financial position, so I had the time. And I didn't have any real good answers. So I decided to come back into real estate. This was over a decade ago now, as an investor. I got back in single family investments, a whole bunch of single family investments, houses, duplexes, quads. small apartments. And that eventually led me into commercial investing. And, one of the things that I learned for myself over a period of time was that single family homes were anything but passive. I stumbled into the commercial real estate, and over the course of the last 5 years, I built a very significant portfolio, and I show others, and we'll get into that a little from the commercial side. My belief system is this. I don't believe any of us were created just to work on real estate our entire lives. Real estate is the conduit we choose, we love, we choose to work in so that we can live life on our terms. Real estate's the thing that gets us the things: providing for your family, college for your kids, vacations, the ability to impact your family, your community, and much more. Whatever it is that is for you, the ability to change your family's trajectory forever. And thankfully, I've been able to find that for myself, or otherwise my family would not look like this today. We wouldn't be intact, is the reality of it. But here's what we're going to cover today for you guys. We're going to be covering how to reduce taxes, passive income, commercial real estate. What does that have to do with passive income and reducing taxes, syndications, and then, of course, open it up for questions for everybody. Here's what we're facing with today. The federal tax rate, the highest federal tax rate today is 37%. That means for every single dollar you make at the highest level, you send 37 cents to the government. A government that has only balanced the budget 4 times in the last 50 years. Not a single one of them has been in the last 20 years. A government which until a couple of days ago was set to shut down. Now, we all love our country. There is no doubt about that. But if you've ever felt like you're being punished because you're successful, that you don't mind paying taxes, but you think the government wastes a whole lot of money and a whole lot of stupid things that you end up paying for, well, this is probably going to resonate with you. I want to talk about taxes and compounding. So we've got a progressive tax scale here in the U.S. This is what the federal scale looks like today for married couple filing jointly, 10% up to 19.9, and then it ratchets from there, 12%, 22, 24, 32, 35, and 37, scales all the way up. Let's put that together. I want to put some actual context together and give you some example, and we'll talk through that. This will all make more sense when I put a bow on it here at the end. So Mike and Beth, they work, and together they earned a combined income of $150,000. On the federal side, that puts them in the 22% tax bracket. Now, since every state is completely different, all I'm going to do today is focus on our federal side. So 22% tax bracket, running their income through the progressive scale, they end up paying $24,497 in taxes each and every year. If you break that down on a monthly basis, it's $2,041 and change. And they're going to pay it every year, forever, as long as that's what they earn and as long as that's what the tax scale is. Here's a fun fact, not so fun. You'll pay more in taxes in your entire life than any other thing. So Forbes came out with a study. They said, on average, if you made $100,000 a year in a 40-year career, your lifetime tax bill will be $763,920. Adjusted for inflation, it's over $1.4 million. You'll pay more in taxes than anything else. You'll pay more taxes than you will for your house, for your healthcare, for your education. Imagine it as a budget. It's the highest line item in the budget. So imagine this. What if you could reduce your tax bill by 50%? It's really not that hard. I'm going to show you exactly how to do it today. So Mike and Beth, if they reduce their taxes by half, they'd save $12,248 each year. Now, if they put that money to work for themselves at, say, 6% a year, here's what it would look like. 6% a year, saved over 20 years. At the end of 20 years, they'd have $477,000. Now, 6% is not that hard to achieve, right? CD rates are awfully close to 6% today. What about 8%? Well, they'd have $605,000 over 20 years. And now I was curious, how long would it take to make $1 million at 8%? At 8%, it would take 26 years. This is simply through the reduction. You don't have to make more money. It's a reduction in taxes. Taxes compounding, saving money in taxes It's great. You can get a tidy little sum in your pocket, but it's more than that. It's about putting that money to work for you and allowing compounding to work its magic over a period of time. I'm going to take a flashback. I see some young folks here. They may not remember exactly what 1987 was like, but Gary, I'm certain you do. Mm-hmm. So let's do a little flashback. 1987, Dirty Dancing was the movie. It was in. So were bangs and shoulder pads. And frankly, the GOAT was in office. It was a different time in history. 1987, the largest tax reform bill in history at that time had just been passed. What it did was a lot of things. One of the biggest was it created passive income. Before 1987, there was no such thing as passive income from a tax code perspective. Whether you made money at your 9-to-5 job in the form of income there, or you had money coming in from a rental property, the income was taxed exactly the same. The tax reform created new rules for active income. Think of the active income as the 9-to-5 job, and passive income. Think checks from rental property or a private real estate invested. The biggest change was this in 1987. Passive losses could only offset passive income. Unless, how about this? Drum roll. Unless you're considered a real estate professional. Tell me more, Neil. Okay, I will. Real estate professional status. Why does real estate professional status matter? Well, if you qualify as a real estate professional in the eyes of the IRS, you can write off all depreciation, all passive losses against all of your income. This will make more sense in a minute if that doesn't make sense right now. But first, what does it take to even qualify as a real estate professional? Well, there's three main qualification requirements according to the IRS. One is 50% rule, more than 50% of the personal services, so meaning the working hours performed in your trades or business during the tax year, were performed in real property, trades, or business. So that the taxpayer materially participated in. The second one is 750 hours. Got to work more than 750 hours. And I know a whole bunch of you as realtors are working way more than 750 hours. And material participation, in which the individual materially participated. You must actively participate in real estate services. It must be your primary source of income. It should be more significant than any other business or some other line item of income that you may have, like a side hustle. It should be your primary role. So, real property, trade, or business. Well, the IRS considers real property, trade, or business one of these six things. So you can work in one of these six professions: development or redevelopment, construction, property acquisition, rental management, operations, or, drumroll, brokerage. Brokerage, trade, or business. Being a broker constitutes real property trade. Now, this is cherry on top. This is a cherry on top for some of you folks out here. If you're married, you file a joint return, at least one of you, not both of you, at least one of you or your spouse, must meet all the above criteria to qualify as a real estate professional. This means this happened to my own mother. My father had sat in a C-suite for years, had a very good job. My mother came in, didn't make as much as him, but they qualified under this, which means there's significant tax advantages for the couple in this situation. All right. Hopefully I'm not losing anybody yet. Let's put some numbers to this. Let's put a real example so you can see at a high level. And then I'll go through, I'll break it down so I can show you how it actually works piece by piece. So let's say the good doctor, Dr. Frederick, earns $500,000 from his day job each and every year. This year, he decided to make a $200,000 investment in a syndication. More on that in a bit. In order for investors to pay as little tax legally as possible, the operating team in this scenario completes what's called a cost segregation study. Now, at a very, very high level, cost segregation study allows one to write off a tremendous amount of the property's value in the year in which one buys it. So let's say the property Dr. Frederick is invested in total was $5 million. The first year depreciation was $1,120,000 of this. So the portion of Dr. Frederick's depreciation that he's allocated was $149,000. Now remember, he invested $200,000. So can Dr. Frederick, he's got this $149,333 in losses. That's what's given to him on his K1. So he can take those and write them off against his income. But what if this is his only investment in real estate? And today he doesn't have any other passive income. Can he just write that off against his $500,000 salary? Well, short answer is no. And the long answer is nope. Dr. Frederick's passive losses can only offset his passive income. Now, remember, if you qualify as a real estate professional in the eyes of the IRS, you can write off any and all depreciation, all those passive losses against any of your income. So let's talk about that. So let's say you, as a real estate professional, you're making, I'm going to use the same numbers, $500,000, just like the good old doc. You make the same $200,000 investment, you receive the same $149,000 and change in passive losses. For tax purposes, you can write off the passive losses against your $500,000 income. So what does that mean? It means if you're in the 35% tax bracket, it's a $52,266 in tax savings. Essentially, all we do is take the depreciation, $149,000 and change, times the tax bracket you're in. That's how it gets to $52,000 and change. This is because you made a $200,000 investment. Your tax bill actually gets reduced. So actually creating more income, i.e. passive income, it can actually reduce your taxes. So let's talk about your tax bill and then commercial real estate. There's two levers for reducing taxes: depreciation and then cost segregation. They kind of work in tangent, and I'll explain on that in just a second. For depreciation purposes, residential rental properties, the standard depreciation period is 27.5 years. And for commercial, it's 39 years. These are established by the IRS. These are the standards. Hey, by the way, if one doesn't think that commercial property is easier than residential, all you have to do is look to the IRS, and they say residential properties depreciate in 27.5 years and commercial properties depreciate in 39 years, which means tenants beat things up much faster than commercial tenants. That's why the timeframes are different. Depreciation is the backbone of the real estate tax code. Sooner or later, we are actually going to have to replace components of the building: furnaces, carpet, windows, roof, siding, etc. Therefore, the IRS allows depreciation to take place on the assets over a period of time. By having real estate professional status, we can write off the depreciation against any of the income in which one has. So how do we actually get more depreciation? I would say, how do we get more depreciation faster? We complete what's called a cost segregation, which I touched on earlier. I'll go into it in much deeper study here. Cost segregation. So it's a federal tax planning process. It's governed by the IRS. It allows owners of property to accelerate the depreciation of the property towards the front end of when they own the property. So remember, the standard depreciation for commercial property is 39 years. For rental property, it's 27.5. The cost segregation allows us to, instead of having it 39 or 27.5, to move a whole bunch of that up to the very first year in which we own and buy the property. It doesn't get rid of taxes or make them go away. It just moves them forward faster for depreciation so that we can alleviate taxes in the front end. How does it actually work? Well, there's a couple of components to it. You end up having it involves a detailed analysis of the building's components to identify those and reclassify them as shorter lived assets. I'm going to do my best to keep you guys awake because this gets real detailed on the cost segregation side. Things like, imagine this, things like flooring and carpet, they just depreciate faster than things like a roof or an HVAC system. So it just breaks things down to a different timeline and different components. Once the components are identified, they're reclassified with shorter depreciation schedules, periods, typically 5, 7, or 15 years. That means that an owner can deduct a larger portion of the property earlier in the years of ownership, reducing taxable income and lowering your tax liability. It should be done in compliance with IRS guidelines, and you should work with a qualified professional, an engineer, a certified cost segregation specialist to prepare the study to meet the standards. This is simply just externally hired. We just hire a third party to complete these things on our behalf. The big benefits: reduces taxable income on the property up front, help bolster cash flow in the first few years. It assigns a more realistic lifespan to the components that are going to need to be placed. At the end of the day, great tax benefits for investors. All right. Hopefully everybody's awake.
We're awake.
Yeah, good.
We're still awake.
Good.
Oh, yeah. You know, what's funny, Neil, is when I used to own my brokerage, we actually offered that service because we did a
Sure.
good bit of commercial work, and we actually charged for it. It was another line of business for us. Cost
Absolutely.
segregations. It's big business,
Big business. There has been a number of accountants, oddly enough, who have done the exact same thing. They built really big businesses in this on the backside of their accounting practice.
Yep.
So how does this help you? All right. So let's bring Mike and Beth back. Remember them? They both work together. They earned a combined $150,000 in the 22% tax bracket, and they were paying $24,497 in taxes. Well, they're friends. Their friends are like yous and me's. They work in real estate. They earn $150,000 combined together. And here's what they decide to do. They want to buy a rental property that ultimately they're going to manage themselves. So the property's $300,000. They put down 25%, $75,000, and they have a cost segregation study completed. The report comes back. It indicates that year one depreciation is $82,100. So their new taxable income now is $67,900. It puts them in the 12% tax bracket. Their old bill, $24,497. Their new tax bill at the federal level, $7,750, a savings of $16,747. How about that? 68% reduction. And I know what some of you are thinking, hey, that's nice, Neil, but I have absolutely no desire to be an active investor. I'm not going to go out and find. I'm not going to underwrite. I'm not going to find a loan, purchase, renovate, and manage a whole bunch of rentals. I got good news. You don't have to buy any property on your own, especially not residential property, to get powerful benefits of owning the real estate property. So that's where syndications come in. Let me give you the high level what a syndication looks like. So imagine a property for $4 million requires a $1 million down payment. You've got two people, one on the right, the general partner, and then a whole bunch of people on the left, limited partners. Limited partners are people who participate in the ownership of the property by investing dollars and cents. And that's where their limit ends. They do not sign a loan. They don't sign a personal guarantee. They are not involved in the management of the property. They just write a check after reviewing all the details and deciding they actually want to be investors. The general partner does all of those things, and the general partner also puts up money, somewhere between 10 and 20% of the required contribution to do the deal with the bank, ends up putting their own money. So they're investing alongside you. On the legal side of this, what's it look like? Well, you have typically a brand new LLC that gets created, and inside the LLC is the property, and that's it. There's no other assets. It's one single property. You've got the general partner there and the limited partners. What types of properties exist in syndications? Well, like everything, industrial properties, retail, apartments for sure, offices. You may want to avoid that today. Hotels, land, gas stations, self-storage, car washes, houses, and a whole bunch more. Just about any type of investment in real estate, there's a syndication out there for it. So I often get asked, what does an investment in a syndication look like? What could returns look like? So, they can look like a whole bunch of things, but I just put together an example of what an investment of $100,000 can look like. So in this scenario, year one, there's cash flow. If somebody's buying a cash flowing existing property, in this scenario, $8,250. And you'll see it increase in year 2, 3, 4, and 5. Why? Well, naturally, we have rent rates. Rents increase over a period of time, whether it's in industrial, which I do a lot of work in, whether it's apartments, rental rates are going up each year, and you should be able to manage the expenses accordingly. So in this scenario, year 5, there's a refinance that takes place to lower the interest rate. It's not a cash out refinance where cash is distributed. It's just one that refinances to end up in a lower rate. I don't know if you guys are like me, but I'd sure bet 5 years from now, interest rates are lower than what they are today. And that's what this example looks like. In year 6, you see a bump up in the cash flow. Why? Because a refinance was done at a lower rate. So 6, 7, 8, 9, 10, and then the sale takes place in year 11, which there is a return of principal along with an increase in the sale value of the property. So in this scenario, an internal rate of return of 11.58%, 134% return over the course of a decade. So how do investors, limited partners, that is, how do they earn? Well, in a couple of ways. One is a preferred return. Preferred return is typically a stated return offered to the limited partners by the general partner. That just means the limited partners are going to get paid X, typically 6, 7, 8, 9, 10%, somewhere in that kind of range in today's world, before the general partner gets paid. Second one is refinance. If there's a cash out refinance, a portion of that, of course, is going to the limited partners, a sale, right? And then tax benefits. So syndications and a tax bill. One can earn income through investing in commercial properties, and then the depreciation, passive losses to offset passive income, right? Any of the losses, the passive losses, can offset any of one's income so long as they're a real estate professional. This is what my company is, Legacy Impact Partners. We empower elite realtors to build and protect their wealth through commercial real estate. Just a little about us. I'll just mention this at a high level. We have about 100,000 square feet across the Midwest. A couple of our properties, Hy-Vee Bakery occupies about 16,000 square feet, in which we have. They're the largest grocer in the Midwest with about 280 locations. Manitowoc is a publicly traded company. They're in one of our buildings, 16,000 square feet and about 3 acres. We've got a couple other asset classes too. Self-storage units, 152 acres in Indiana. A Dollar Tree, everybody knows good old Dollar Tree. And then an orthodontist office, which they've got just north of 200 locations across the country, and they occupy two properties, which we have. There's a couple of transaction highlights on the right side. A retail strip mall, there were 8 tenants in this particular one. And our strategy when we bought it was to execute on an expense reduction and ultimately lease enforcement. We bought it in 2019 for $817,000 and change, and we sold it in 22 for $1.5 million. An owner-occupied office, and I know a whole bunch of you guys are both active and passive investors. This one is interesting from how we executed, but as an owner-occupied office, we executed on a sale leaseback strategy. So we bought it from the owner, they leased it back from us on a 3-year triple net lease. And we just did immediately turn around and sold the property. 60 days is what we owned it for, and net $106,000 on this property. The investors did well in that one. And then a medical office portfolio, 2 buildings, which we bought there, both national tenants. It appraised at $2.5 million. We actually purchased this property at $1.5 million. So I wanted to give you, something of value. We operate a community called agentoptional.com. This is ultimately about empowering elite realtors to protect and build their wealth through commercial real estate. We have a little giveaway on that website. It's called the Agent Optional Playbook for elite real estate agents, 100% free, a little playbook that goes into a little further depth of what I'm talking about here, about how you can build and protect your own wealth through commercial real estate investments, whatever that happens to look like. Yes, we are investors. We do offer investment opportunities for folks, but if that's something you want to talk about, great. Otherwise, that elite optional playbook for real estate agents, that would help move things further along in you guys and give you some additional education and resources. So at this point, I want to open it up for Q&A. I've seen some hands pop up here. Gary, you tell me, how do we want to facilitate that? And then we'll just, we'll fire away here with Q&A.
Did you know that you can participate in class every Monday? We call it Monday Night Live, 7 p.m. Eastern, with me and dozens of other investor agents from around the country, in fact, the world. Every Monday, totally free. No selling, no recruiting, just straight up education on anything and everything in real estate. And we have a lot of good guests coming on once or twice a month, bringing in expertise on subjects like how to buy a house with crypto. Okay. How about them apples? What about AI? How's AI affecting our business? How about the metaverse, blockchain processing? We're already using it in title work. So come on to Monday Night Live, be ready to take notes and ask questions because it's live and engaging, and you get to participate by asking questions and meeting others. So we'll see you there. Go to GaryRealEstateWithGaryWilson.com, click on the resource tab, drop down, and you'll see Monday Night Live. And in there, you can see one of the most recent classes. But more importantly, you can register for class as many as you want going up to like the end of the year, I believe. So in any case, do that. We'll see you on Monday Night Live. Look forward to meeting you in person. Take care. Yep. So there's a couple questions in the chat box. If you want to pull it up.
Yeah, let me stop the share and pull it up.
Yep. PF Unit is the first question, and that is, do you also have tax scale for single people? I think an example, we showed a couple of Beth and
Yes. I mean, you want to just Google the tax scale, US tax scale for single filers. It will pop right up there on Google. You got it.
Okay. And then Melody from beautiful Texas is asking, can you please all talk about what happens when you sell the property? When would it be good to have a cost segregation study? Take advantage of that.
The cost segregation, the cost segregation study is best when you plan to hold the property for I would say, mid to long term. If you were going to hold it for 1 year or 2 years, it would really probably have to be strategic in terms of your ability to do the cost segregation. Because what happens when you sell? Well, you have a couple of things. You have capital gains. Let's say you sell it at a gain, right? You have capital gains that kick in, and you also have depreciation recapture that is there too. How do you get around that? A 1031. You're going to roll that gain in and buy another property. That would be the way around, or to defer that, not really around it, to defer that. And so you'd want to be strategic about when you do that. It's best holding that thing for a period of time.
Yeah.
Great question.
Yeah. The average hold time looks like statistically, and I think this is across all investment properties, is between 10 and 12 years. I have no idea why it is. But oddly enough, my average hold time was around 12 years. I look back historically, and after 12 years, that was the average that would sell them on average. Some I sold sooner, some later. Yeah. But another good question is, when we're talking about the people that can do a cost segregation, like an engineer, an accountant, and so forth, what I did is, we had the brokerage, and I was the broker, and understood the concept because we used it. We bought first time I used it, we bought a 90-unit building, my partner and I, and we started right away. But I also had a commercial broker on the team who had already done that through Marcus Millichap. He was pretty big on Marcus Millichap, and he said he'd like to do it again. Can we offer it? And I said, heck yeah. So the company got a portion of the profits he made from offering that service. So guys, you do have to be qualified. I mean, Karen Green's she's on tonight. She has her hand raised too, but she may be a person that could offer that service, and legitimately, generate a profit. Now, there are some agents on here who do focus on commercial. About 10% of us do that, So yeah.
No, I see Karen's hand. So let's have her fire away with a question. Okay. If she can unmute. And also, somebody just sent me a private message here. I just posted that link to agentoptional.com in the chat room.
Thanks.
Hi, Neil. Okay. Hey, I'm curious as to, now it may just be because of the example you gave, but do you focus at all on multifamily properties? Because I noticed that there weren't any examples of those.
Yep. We have some in the portfolio, but no, that is not our focus. Our focus at my company is largely industrial based.
Is there a reason that you like to stay away from those?
Is there a reason I like to stay away from those? Yeah, because it's like not fun to manage or touch. apartments.
Yeah.
The gray hair. Yeah. And so there's a different, Baskin Robbins mastered that. There's a different flavor for everybody. And so the industrial property, the idea of a 5 or 10 or 15 or 20-year lease with scheduled lease rates over the course of a period of time, the ability to go to an insurance company and lock in a fixed rate for 10 to 20 years is pretty attractive. And the ability to push all the expenses, property management, maintenance, insurance, roof, structure, parking lot, to the tenant is pretty attractive. So that's why my company has chosen to focus on that.
Okay. Even with a professionally managed, group or something, right? I mean, just curious. I was just curious as to.
Yeah, we have some in the portfolio. And management is a whole nother, is a challenge. It's a bear. I was I was in a conference over the weekend and I sat in on a panel for property management, and one guy was there, 15 years in the business, manages, ready for this, 17,000 apartment units. And he said, I have never once, he's a property management guy. I've never once made a profit managing property. I said, well, how in the world are you in business? He said, well, I partnered with guys and we managed to buy 10,000 units over the last 8 years. And my contribution to this partnership is the property management side of the business. That's how it works.
It's definitely easier. I agree.
Yeah. Guys, I'll give you a big tip. I think Karen, you and I talked about this. Every metropolitan area typically has what we call like an apartment association, just like you have, there's associations for everything in life, but you have local investor clubs and things like that. Well, there's actually, you can find a local apartment association, and it's an association of property managers. Well, some of the members are actually big property owners. When I first got started in this business, just one of those, lucky ideas, I thought, I need more guidance. I need more help. So I thought, I'm going to go to this dinner. I just started looking up things and thought, well, I'm going to go to this dinner. They had this dinner they were offering. And I purposely picked the table, and please, no offense implied here. I picked the table with the oldest guys. They said, I thought, well, they probably know more than everyone else because they've been around longer. And let me tell you, it's one of the smartest things I've ever done, man. I got invited to play golf with them. One of them, Gerhard Flufelder, was 72 at the time, took me under his wing for the next year, showed me how to do what he did, and I did deals with him. He was getting ready to start selling his properties to retire. And I bought some and I helped other people buy some. And eventually I did a lot on my own, eventually did a partnership out of that. It's one of the smartest things I've ever done. Just a crazy idea. It was like $40 for the dinner, and it was good food too. So, but that networking, I can't tell you how important it is. I always promote networking in terms of being an agent, but think about the benefits of networking in terms of being an investor too. You might not have money to put down a big down payment, but just like this other person did, you offer what you can offer, which is your time, energy, and knowledge, and be 10%. Even if you got 10%, that's 10% or something you didn't have yesterday, So networking is huge. Probably the top 3 things in all my business years. Top 3, networking is definitely in the top 3, the critical things to do. So, I mean, Neil, talk about a little bit about the syndications. I mean, would you agree? You can't just step into that. I mean, it's part of it's you because people. You've done networking. You're
right. Networking.
Pretty good at meeting.
Yeah, you've got to be good at a handful of things to be in syndication. First, you good at identifying property and of course executing a business plan to be able to do that. And networking, for what we do when we buy property, industrial property, we're buying it through other brokers, typically in an off-market fashion through other brokers. And how do you get there, Gary? And how do you get, we do this through the Midwest, is building relationships, networking with agents, because they have choices, just like everybody here as an agent. When you find that property and it's a killer deal and you're going, who do I call? Because you only, the right property, the right price, you only need one phone call and it's sold, right? Yeah. So that's the same type of thing as networking with agents to create a reputation so that when we get a property and when that agent gets a property and it's a deal, we want to be that first call. And they want to know we can close. that we can actually deliver on what it is that we can do. And then, of course, connecting with investors, the right people. For us, that means real estate agents, helping them get out of that, becoming agent optional, allowing them to have the freedom and flexibility to do what they want when they want.
Yeah. It's funny. I just thought of another one, guys. How many of you remember me telling you about how after about 3 years investing, I wanted to leverage the equity I had in my properties. And I found a guy who was a commercial lender who actually gave me what's called a blanket mortgage. It covered all the properties I had. Yep. And it was second position. And I've had people tell me to this day, you can't do that. Commercial lenders always make you be in a first position. So, well, I did it. His name's Larry Newman. And by the way, I still know him. He's still alive, and he still lends. I met him through the apartment association on the next dinner. It wasn't the RIA group, so I got a lot from the RIA groups, but the apartment association, that's where I met the big players. And you just sit down and talk to them, you'll find out they're just as regular and normal as anybody else, and they're hard workers, they're entrepreneurs. So in any case, another question from, let me go down here. I think it was Toya. Hang on one second. Toya, is it better to buy an investment property in an LLC or an S corp?
Good question. We buy everything in an LLC. That's been the way for years and years. I'm gonna suggest talk to your accountant about your unique personal tax situation.
Yeah. And Toy, I've asked that question too before of several tax people, and I only met in all my years one person who bought properties in an S corp. Nobody else. S corps are really good for, like, a lot of us real estate agents have an S corp that we run our transactions through. Run our commissions through, because it gives us some tax benefits. It's meant for people who have small businesses. If you have a service business, S corps are great. And again, it's just my opinion. But as far as property ownership, man, it's hands down been LLC, sometimes in combination with a trust or exclusively in a trust, but that's a whole different subject for a different day, but definitely talk to your tax guy and say, hey, what do you recommend? Okay, next cost. This is from a brand new agent on the team, Michael. Are costs shared among investors as well as large capital expenditures? Can you explain the triple net lease?
Yeah. So, yep. So how are costs shared? Well, there's a couple of things that take place. One, a number of those costs and expenses are underwritten for it to be the case. And so if you were to look at a syndication, you'd want to understand from the general partner standpoint, what underwriting did you put in place? What expenditures you in place? Did you budget for, capital reserves or expenditures that may come up, furnace, air, whatever? In every situation, the property type is different. And so you'd want to make sure it's underwritten, that's the case. And then can you explain the triple net lease? Yes. So triple net means that the maintenance, taxes, insurance, all the utilities, all the expenses and the maintenance of the property are borne on the tenant. The tenant pays for all of those things. Mm-hmm. Everything that's there. So when it's in its purest, I'll complicate this a little. You'll see this in a triple net lease, and then there's one above that called an absolute net. I'll give you Walgreens, McDonald's, all run absolute nets, meaning that if they want to completely redo their building, they're just going to completely redo their building. They're going to remodel the whole thing. They'll probably notify you, but they're going to do everything. They just take care of it all. Anything that breaks, whatever it is, they are solely responsible for. On triple net deals, you need to read the leases. Sometimes there's carve outs for things like a roof, a parking lot, glass. It just depends. But the overwhelming majority of costs are handled by the tenant.
I've even seen common area maintenance. Like you have a little office building, maybe 6 offices, 2 on each floor or 3 floors. Even the common area maintenance is divided up and split between the 6 tenants. Sometimes the owner will take it on themselves, but I've even seen the common area maintenance handed off to the tenants on a triple net lease.
Well, so we've got the same thing. We've got a building we just bought about 60 days ago, 12,000 square feet. There's actually 4 buildings, really uniquely built, each 3,000 square feet apiece. So 4 buildings total, 12,000 square feet total. So we have common area maintenance. We have to mow the yard, the grass for the entire property. And we do that through common area maintenance. What we also do is, this is out of state for us, so we need a property manager. That property management cost is billed to the tenants. We as the ownership do not pay that. The tenants pay that. Everything's billed back.
Yeah. Another question from Michael is, do you have to be an accredited investor to invest in syndication? I know there's variations of that, but go ahead and take that, Neil, if you don't mind.
Yeah, it depends.
Yes.
How do you like that? How about everything here is always like, it depends. It depends specifically on the type of syndication, the type of raise that one is doing under Regulation D. And so when one files those papers and designates how they're raising, there's typically two ways to go. Either all accredited, and in many cases, when it's all accredited, it allows advertising to take place. So if you ever see, we have X number of IRRs, and you see invest in our multifamily on Facebook, a whole bunch of things fill into my feed all the time. That is accredited only because they're allowed to advertise. And then the other one is when you can take a certain amount of non-accredited investors. Still have to be sophisticated, still have to know what they're doing, still have to have a prior relationship with the general partner. And in those scenarios, you can't advertise. It's a lot of word of mouth, and for us, it means, if that's of interest to anybody, it's going to our website, it's having a conversation with Ava on my team, it's having a relationship so that if we get an opportunity and we send it out, there's a prior existing relationship.
Good. And Toya is asking, can we request an info meeting to discuss establishing company trust and holding company benefits? And Neil, if you're comfortable talking about it, I don't mind. I know I've done, so Toya, I've built holding companies myself, but I was advised to not put a company like that in a trust. However, I was advised at one point to set up another trust, a business trust, to hold the business in there. And you actually sell your current business to the trust, and you create a note and so forth. And but the personal trust, you want to keep things separate. Beyond that, I couldn't. That's way beyond my pay grade to go into all the details. I mean, Neil, have you done those kind of things yourself?
No, past my pay grade, my friend.
There you go.
We've done a whole thing with the IRAs and 401k self-directed work on the investment on the personal side, but past that relative to this, no.
Yeah. What we'll do, Toy, is we've interviewed several hundred people on the podcast, and I'm pretty sure we have somebody that's talked about trust. So Toy, if you go to the team website, it's Gary Real Estate with GaryWilson.com. You can just do REWGW.com. You have to click on members area to log in. No, I'm sorry, you don't. You don't have to log in. Anybody can do this. You can click on resources, the tab up top, and look for podcast. Click on podcast. Then you're going to see a little search bar, a little magnifying glass on every screen anywhere on the website. You can type in trust. Well, you might get a whole bunch of hits on the word trust, but you can see the entries that are podcasts. Look for the podcast to pop up with the word trust in it. And let me know what you see. Read through the descriptions. Anyone that you see that you like, I'll call them and see if they want to teach a class. In fact, a lot of our teachers come from the podcast we do. Whenever something's like spot on, because so think about this, Neil. Everybody here that's an agent is what we call an investor agent. So they work with investors. So this is the kind of stuff that they can. Then this is why I wanted to have you on for you personally. Is they promote this to their clients, who then reach out to you and take the next step there, as well as the agents themselves that do invest.
Sure. Yeah.
So okay, let's see. Kendra, any syndication, did you say there are two types of investors, general and limited partners? And if so, what's the difference?
Yeah, you've got it. Two types of partners, two types of investors, a general partner and then the limited partner. General partner in our scenario is myself and my team. We find the deal, we underwrite the deal, we handle everything relative to the management of it, the orchestration of getting the loan, signing a personal guarantee when it's required, placing the insurance, underwriting the tenant. So all of the heavy lifting, if you will, from making sure that we build a business plan and then we've laid out the groundwork to be able to execute in the business plan. The limited partner is limited to the dollars and cents in which they invest. That is their contribution and that is their limitation. There's no involvement in the property management, any ongoing basis. We simply keep everybody up to date, communicated with about what is happening. We're available for phone calls and conversations through that process and keep everybody informed of what's going on. And then distribution checks, of course, that gets sent out as well.
Yep. And Melanie's asking, similar to what Mike was asking, do all of your investors need to be accredited and Neil, go ahead and if you want to recap, I know it depends. It depends on the deal,
Yeah, it depends on the deal and how one raises money. So no, not everybody has to be accredited. It just depends on how one is raising money under Regulation D. For us, in my world, just so you know, is most of ours are, we have both accredited and non-accredited investors. In order to take money for us from non-accredited investors, it requires us having a conversation and building a relationship with you before there's any sort of investment opportunity that's sent out to you. If that's something of interest to anybody, just go to agentoptional.com and get the playbook, and then you'll see a spot to schedule a conversation with Ava, who's ultimately our capital raiser. She's our head of investment relations here at my firm.
Okay. All right. Any other questions, guys? I know we're right at the top of the hour.
These are great questions.
Yeah, perfect time. Yeah. Yeah, good questions. I appreciate you guys being engaged again. I mean, I love this group, Neil, because they do participate. They ask questions and they're engaged, and obviously we have the right kind of clientele that can benefit from this. So, guys, just remember a couple of key things, like cost segregation. That's a big subject. And while you yourself may not be qualified to perform that for your clients, you can at least introduce it to them and say, have you heard about this? Did you know you can accelerate the depreciation that you can get on your property by segregating out these short-term items like cars and appliances and carpeting and things like that. And it really adds up. But we did it for that building that my partner Vince and I bought. It was substantial, guys. It was a major contribution to our bottom line. I mean, it was very beneficial. We had that period. That was an 8-year holding period. We held it for 8 years.
Gary works on commercial properties, apartments, car washes, works on houses. And then, if somebody bought a property a year or 2 years ago, they can still do it today. So it doesn't have to be, you get the most benefit by doing it in the same year. If somebody brought a 2-pack, 5-pack, 8 houses and never done it, they can move that up and make a tremendous advantage and, as you said, offset some very significant income real quick.
Yep. Actually, that's a good point. So guys, if you know people that already invest, remember, this isn't something you just have to do from day one. Obviously be beneficial, but let's say they've owned it for 3 or 4 or 5 years and they look like they're going to hold it long-term. Introduce it. As soon as you do, they can benefit from it. Karen, have you ever done anything like that before?
What, the cost segregation?
Even for your businesses? Yeah.
Dumb. No, I haven't. I should have. I mean, yeah. I will in the future because obviously it's a really important thing to include. I should have done it in my businesses, but I didn't. But going forward, I definitely will.
Yeah. And how about Eric? Did you ever do anything like this, Eric? No. How about Mike McGran? Down in another Texan. He may have stepped away for a moment. Okay, let's see. Here's another question from Kendra. In doing a cost segregation, does that reduce the number of years or dollar amount of the 27 / I think she had 39 years? 39.
Does it reduce the number of years or dollar amount? You're going to, let's say, for example, you bought a property and 20% of the value of the property's land. I'm just going to make up a number. 80% is the structure of the property. So the land can never be depreciated. It's only the structure. You are, that 80% is just going to be moved up. So essentially it doesn't change up their 27 and a half or 39 years, but it's going to change the dollars and move them to the front load that very heavily is ultimately what it does. So it doesn't change the overall dollars at all, though. It just moves them up front.
Yep.
Yep.
PS, actually, you may have just answered this. PF was asking, what's the smallest property portfolio you'd recommend cost segregation?
Example, 100 grand probably. You can do it on a house. The cost of, most of these people have electronic reports when they generate for the houses, $300 to $500, somewhere in that kind of range. So it's very inexpensive to be able to execute on that.
Yeah. Remember, guys, you do have to pay somebody. Oh, go ahead, Karen. I'm sorry.
I was going to say, don't people generally, they'll just list those as chattels? I mean, that's the way they used to do it, as opposed to an actual cost segregation, right?
Yeah.
But
I think, at least, Neil, correct me if I'm wrong, we still did the cost segregation, I don't know if hopefully we did it right. I mean, it's a long time. I probably shouldn't say anything about the IRS on a recorded live call, but
it's just when we've always done it, just had the cost seg done. They generate an electronic study on that to be able to do it even on $100,000 or $200,000 house.
Okay, I was just wondering, because then you also have a reduction in the cost of the tax burden, the actual transfer taxes and things like that, if you do it as a chattel, right?
Well, you do want to do a study. Absolutely. Before you complete the sales agreement, before you go to closing, you can modify the sales agreement if you need to. You would definitely want to compare. You want to do it both ways and see which way is most beneficial. Okay. But you got to think, am I going to hold this for 1 year or 10 years?
Right. Yeah. Hey, most, for everybody's benefit, most of the companies that are out there who do these studies will give you first an estimate of what it's going to cost to actually do this, and then also an estimate of benefit. Here's what we think we're going to be able to save you in upfront. Here's what we believe it's going to look like, which is great. So that PF, if you're in that situation and go, is it worth it or not? I don't really know. Get the estimate, and then you know how to execute.
Yep. Yeah. Okay.
Gary, you have a question?
What question?
You've got a question in the, I'm fine, Gary. I just noticed that you have a question in the guest box, and I don't know if you got to it because I've been jumping back and forth with clients.
Well, I'm going through the chat now. I think I've covered them all there. There's Mike's just saying he's working the phone. That's why he couldn't unmute himself.
There's one in the Q&A.
Yeah, in the Q&A is what I'm talking about.
Oh, gotcha. Let's see. I'm wondering if you know of any private lender. It's actually not really related to the subject, but I guess Sam's asking, does anybody know a private lender in Florida, good short-term property? He can manage the property as well. 5 bedrooms, 2.5 bath, 5 minutes from Disneyland. So if you guys, anybody have any interest in that, or know anybody that may have interest in that, reach out to Sam. Good to see you, Sam. I apologize. I'm so used to the chat box. I never look at the Q&A box. Okay, Melanie, got to run. Thanks, Melanie, for joining us. Good to see you.
Thanks for having me.
Yeah. Okay. Any more questions, guys? Well, this would be a record if we wrap it up viscerally. Usually we go, oh, go ahead, PF. I'm sorry.
Maybe the final question. Neil, when you first got started doing this, do you rather work with a local cost segregation company or a national cost segregation company?
Good question.
Who would be a better resource?
I got turned on to a company 6 years ago for the first industrial property that I bought, and I've used the same company ever since. I was happy with them. They communicate well. I take that back. We just did one last year with somebody else. In fact, I'll go back to what I said earlier. We got an estimate from them, and what you'll find is every property has a different set of benefits. So you'll find industrial property just looks different than multifamily, and that looks different than mobile home parks. We bought a mobile home park last year at the end of the year, and I ended up getting 2 quotes because I wanted to compare benefits between companies. So we ended up going with a different company on that one. Yeah. So whoever you're comfortable with, it's tough to go wrong getting 2 or 3 quotes. Just compare and contrast.
All right. Thank you.
Yeah.
Yep. It's funny. I'm looking. Go ahead, Karen. I'm sorry.
No, do you generally do a lot of your business in certain states, or do you just do it wherever you find the deal?
Yeah, through the Midwest. That's our core focus, through the Midwest. I'm in Iowa, and we border 5 states, so we're focused right, within about 7 hours driving distance. We can cover a whole lot of ground.
Right. Okay. Yeah. If you were to do it nationally, would you potentially use 2 or 3 different cost segregation companies, do you think?
I still would get a couple of quotes. I mean,
yeah.
The guys I use, I think they're out of San Diego. I mean, they fly everywhere, right? So they're just everywhere. And what you want to know is how long they've been around, what's their background. If I get challenged on this study, meaning the IRS, challenges the depreciation, what we've done, are they going to live up to? They got to back it up. So how long they've been around, those types of things really matter a lot to know that we're good. And sometimes that means being a little more conservative at times, not pushing the envelope, if you will.
Thanks.
Yeah.
What's interesting is, of all the people I've met through doing this business, most of them are either focusing on the Midwest or the Southeast, like Texas to North Carolina, and that whole, including, by the way, like Tennessee, that's not a coastal state, but in there. And oddly enough, I'd say more people in the Midwest, slightly more than the Southeast. And one of the reasons is, if you can pick Nashville, Kansas City, St. Louis. If you look at those cities and look at the highways that spoke out from there, you have access to several major metropolitan areas, like you said, in less than a day's drive. Just makes it easy, So,
I sit in Des Moines, Iowa, 5.5 hours from Chicago. I'm 3.5 hours from Minneapolis, 3.5 hours from Kansas City, 2 hours from Omaha. It's millions of people within, 5 hours plus or minus.
Yeah. And I can guarantee you, and I know you got traffic there because I've taught in all those places.
You have, you've
but
been
there's
there.
nothing compared to I-5 and I-95. It's just crazy. But yeah, your traffic's everywhere. But where you are, it's definitely easier, So
we get a whole bunch of trucks coming through 80 and 35 where I sit, literally in the middle of my city.
That's right.
Yeah.
So I can't figure out what are those yellow bugs that I've driven across, like, North Dakota, South Dakota, Nebraska. And there's something about summertime, these yellow things just coat your windshield. I don't know if they're moths or what they are, but it's every summer. Is that a typical thing? Or is
it varies. You can go weeks and everything's normal, and then you'll literally drive home just after the sun goes down, and it's just horrendous. You're driving, what you're driving through.
You can't keep up the windshield wipers.
No, it doesn't matter. Yeah, I know.
But I got to tell you guys, some of the nicest country in the U.S. is in those areas. If you get a chance to get out there, take the opportunity. Just beautiful, beautiful country. Awesome people too, and lots of investing. Consider the cost of those areas compared to some of the coastal areas like San Francisco, L.A., New York City, Washington D.C. I mean, there's a lot of they call it the heartland for a reason. People have heart there. We could go on and on. I know we're running on time here, but Neil, man, I really appreciate you doing this. I know that was a big ask, and you really delivered. Anything we can do, like that website, agentoptional.com, is that just for the agents, for listed agents? Like, what about consumers that these folks represent?
Yeah, that's still the best place. It'll ultimately redirect to our company name, Legacy Impact Investors. Okay. We're completely focused. The world I came from, I've been a licensed agent since 2004, nearly 20 years. And so I fully understand what you guys go through, what you live with. And and ultimately my own experience coming through that. And so, they always say, who are you best to serve? Who are you most qualified to serve? And it's really the person who you used to be. And so with what it is that we do, it's turning around going, I know we've had success doing a number of things. It's, if I had this when I was at Remax at 29 years old, performing at a very high level, I'd probably still be at Remax today. I would have built a massive passive income, and I would have just taken control of my time and not had such a personal challenge with how I worked my business and wreaked havoc, if you will, in my personal life. And so that's who, we're really built to serve.
Yeah.
We do have a number, Gary, we do, to further your question, we do have a number of investors who are not realtors, ultimately friends, family of us, a small group. I've been in this town for a long time, sold literally, 1,000+ houses. So a bunch of past clients, a bunch of people who are not agents, are investors. Yeah.
Awesome. Okay. Well, I appreciate you doing this. I know I lost my finger many years ago because I was Mr. Workaholic, and totally oblivious, had no clue. And here I am. But this definitely, I'm telling you guys, working with these investors, everything has its headaches, its pros and cons, the yin and the yang. But overall, to me, it's much easier working with investors. And the higher you go, the easier it gets. I don't know how to explain it. It's just maybe because you just get more used to it, you learn more, you know more, and they learn to trust you. There's a lot to that, but if you haven't already started on that journey, best time to start is right now, because the market is right at that critical moment. We don't know if it's going to happen this year or next year. Year 20. I don't even try to guess. Every time I guess, I get it wrong. When I don't publish my guesses, that's when they're right. But who people are saying next year, some people saying 2025. Who cares? The bottom line is prepare for it. You can't go wrong with being prepared. So, in any case, great time to wrap this up. You guys have an awesome rest of the week. Remember, I'm at the conference. You won't see any scheduled times available this week, but in an urgent matter, obviously call me, text me. I've already had 3 today. And if it's crazy enough, I step out of the session. If it's something going to wait, I'll call you when I get a break. But I'd rather have you call me, and if you're in an impasse on something, instead of guessing or missing an opportunity. So don't be afraid. Just remember, I'm at the conference with a couple other folks on the team. We're going to bring back lots of good content for you too. So, yeah. All right,
Gary,
Neil,
thanks so much
again,
for having me. I appreciate it. Good to meet everybody. Good to see everybody. Thanks for having me here.
You're very welcome.
Thank you.
Thank
Have
you.
a good night, everyone.
Thank you.
Bye.
Bye.
Thank you for watching this episode of Monday Night Live. Be sure to subscribe to our channel and go to realestatewithgarywilson.com to join our community and start building wealth today.